So a lot of headwinds when it comes to China at the moment, a lot of concerns about whether they'll be able to reach that around 5.5% GDP target. You, though, are looking at this as an opportunity.
Yeah, I think if you look at the longer term, the valuations of the Chinese market is actually really very, very attractive at the moment. They need to get COVID-19 cases consolidated, stabilized. They need the property market to actually recover from a sales volumes perspective before we think that the market can actually rebound in the second half of this year. We do think that the government is likely to actually ease a lot more because given the current state of the situation there, unless they ease a lot more, the economic growth is nowhere near the 5.5% target that they're actually looking at. In fact, we're probably talking about closer to about 4.2 to 4.3% right now, as things stand.
We saw a recovery in Chinese tech ADRs overnight. Do you see that being extended to their Hong Kong and mainland listed peers, or are the fundamental kind of concerns going to be dragging for a while?
I think it's going to drag for a while, actually. I think a couple of weeks before this, we actually had some good indications that the crackdown, the regulatory crackdown on the Chinese tech sector was more or less done with, given the fact that it started reissuing mobile gaming licenses again. But unfortunately, with this kind of COVID situation going on, with districts being locked down in a very big way, it's kind of hard to get any momentum where the Chinese equities market is concerned. So unless we get some signs of stability where COVID-19 is concerned, where the property market sales volumes are, in that sense, it's going to be very hard for the market to actually get any sort of momentum going forward. And of course, we had this debacle over the Ant Financial investigations as well. All of that is basically setting back sentiment and affecting institutional investors and preventing them from coming back in a big way.
So what are some of the defensive sectors that you like in this environment?
We do think that the tech stocks are still pretty attractive. The key is that when you buy into the Chinese market right now, you really have to be patient. You need to buy it with at least a 6 to 12 months outlook. You can't be buying it with the view that the market is going to turn around and make a 20% or 25% gain over the next 3 months. That is not something that you should be doing. You should be buying it with a 12 to 18 months outlook, given the fact that valuations are really, really attractive. Earnings revision downwards is pretty much at its bottom, and therefore, in the next 6 to 12 months, we should see quite decent earnings growth coming through. We do think that the second quarter earnings growth, earnings numbers will probably be the bottom, and that after that, we should think that we do think that there will be a recovery of sorts where earnings growth is concerned.
What role do Japanese equities play in your portfolio, given the weakness of the yen, not to mention the BOJ just continuing to double down on loose monetary policy? Yeah, I mean, I guess you're referring to the correlation between the Japanese yen and the Japanese equities market there. And traditionally, weak Japanese yen has always been pretty positive for the Japanese stocks, given the fact that the Nikkei is dominated by exporters. But I think the situation this time around is actually slightly different because of the fact that, a weak Japanese yen with very high commodity prices basically means that a lot of the margins of the Japanese corporates will probably be affected unless the production is mainly overseas and unless their sales are completely overseas as well. And there are very few Japanese companies in that sort of category. So unless you're actually able to actually unearth these companies, most of the Japanese market will probably be stuck trading in a very, very tight range until the BOJ actually does something about the Japanese yen and perhaps actually hike by 25 to 50 basis points to actually try to avert this continued weakness in the Japanese yen. It doesn't sound like they will do that anytime soon, though, does it?
Yeah, I don't think so, because of the fact that, for a very long time, there's hardly been any inflation in the Japanese economy. And therefore, you want this inflation pressure to actually build up a little bit more, to actually try to encourage the domestic consumption, which has seen a little bit of a recovery in the last couple of weeks to actually gain a lot more momentum. On top of that, the global situation is such that with the war in Russia and Ukraine escalating yesterday, with the fact that, the Russians are banning gas exports to Bulgaria and Poland, there is hardly going to be any strong demand for consumer tech gadgets going forward. And of course, when you look at the US with the mortgage rates going up, with gasoline prices at above $4 per gallon, it's going to be actually quite difficult to expect spending on tech gadgets to actually increase over the foreseeable near term.
You talk about the war in Ukraine continuing. Does the dollar remain the haven currency of choice? And what do you do if you're feeling defensive?
I think for the near term, certainly, because as we move closer to the May FOMC meeting, where we expect the Federal Reserve to hike by 50 basis points and also to start quantitative tightening, that in turn will likely drive the U.S. Treasury yields upwards and subsequently actually extend the gap between the U.S. Treasury yields and all the other sovereign yields as well. That in turn is likely to actually continue to provide strong support for the US dollar. And in light of the situation in Ukraine, we do think that the dollar on a very short-term basis will likely remain the currency to actually watch. But on a medium to longer-term basis, I do think that with structural inflation much higher than before, that countries are probably not likely to actually have their currencies too weak, because if you have your commodity prices denominated in the US dollar as well, you're just going to be asking for imported inflation to actually drive up your domestic inflation numbers. So I do think that on a medium to longer term basis, the strength of the dollar is probably likely to be less warranted than what it is right now.